This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
You've got the best podcast going, Jason. I love your show, man. It's good stuff. What I wanted to share was my wife and I, for the first time ever, paid effectively no income tax in 2022 through doing a cost segregation study and generating about a $200,000 paper loss on our real estate. I'm a real estate professional, and it really works.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 2056. Today we have a really interesting show for you. And, some of my guests are just super interesting, and this guy is one of them. And I think you're going to enjoy this interview a lot. We've got Neil Bawa back on the show for a second time. He was on about, 8-10 months ago, and we've got some really interesting discussion here for you today. So without further ado, I will get right into it. Let's go to our guest. It is my pleasure to welcome Neil Bawa back to the show. He is considered the mad scientist of multifamily. He's a data analyst. He's raised approximately $1 billion. I don't know, he can give you the exact number for commercial real estate projects and build to rent projects. Last time, it was almost a year ago that we had a very interesting, fascinating conversation that could have lasted at least twice the time we did. So we're going to do it again today. Neil, welcome back. How are you?
Fantastic. It's great to be back on Empowered Investor. Thanks for having me.
And remind our listeners, where are you located?
I live in the San Francisco Bay Area in Silicon Valley because, I'm a tech geek, I'm a nerd, and this is a massive collection of tech geeks and nerds. I don't invest in California, though, so I have investments in 17 metros, and none of them in California.
Yeah. That's interesting that you say 17 because at my most over-diversified stage, I owned properties in 11 states and 17 cities. So that's...
Are you saying I'm over-diversified? Is that what you're saying,
it may
Jason?
not be for you. If you have the management infrastructure, then no. But for me, that was a mistake, which I have freely admitted many times. We tell our clients be in at least 3 markets, not more than 5, because you can kind of keep track of that in your brain.
Yes.
To some extent, and not that you'd want to, of course, we use software, but, you can sort of know offhand, what is the taxing agency there? Who's your insurance broker there? Who are your team members in each of those markets? You can kind of just think about that in your mind. But when you're in 17, it's harder to do that.
Very, very difficult. And I'm lucky to have a fairly large team, so 30 plus employees and 2 different companies. And also I have 9 partners. So some of these partners, they're the ones that are keeping those numbers in their head. So I'd say probably for the markets that I need to keep them in my head, probably 7 or 8. So it still doesn't match your rule of 3 to 5, but at least I'm closer.
Sure. Well, these are for, we deal with more mom and pop investors right. Most of the time. But Neil, you do single family build to rent projects. We'll get into that and talk about that. But of course, I'd say the worst segment of the real estate world right now is office space. Mm-hmm. Retail has been under attack for a couple of decades with the Amazonification of the world. Yes. There's been a retail apocalypse. But multifamily, more recently, starting about a year ago with these rate hikes, multifamily apartment complexes have been in some real severe trouble. And we have a record number of new apartments under construction that are hitting the market. And we have a whole bunch of apartment syndicators that have gone out and, they've done the imprudent thing, a lot of them, that you should never do in investing. And that is betting on something extraordinary to happen in the future to make your deal work. And with these rate hikes, those deals no longer work. So a lot of them are really in trouble. Tell us about what you see going on there, and then we're going to dive into some other topics.
Sure. So, as you mentioned, office in basically ridiculously unbelievable amounts of trouble on the commercial side. Retail, not in trouble simply because of the apocalypse sort of being phased out over the last 10 years. There hasn't been a lot of new retail construction. So prices have fallen, they've adjusted, and the retail market has learned to live in a smaller, simpler environment. And so not necessarily in trouble. Multifamily is the darling of the commercial space. Unquestionably, it is always number one in everyone's list, from the retail investor all the way to people investing, $200 million a project. And it's still the darling. So that hasn't changed. Every investor that has been asked in the last 6 months, what is your biggest allocation in commercial real estate? The answer has always been multifamily. So they all want to invest, but they're very aware that the sector is facing distress. And the distress is simply because in late 2022 to late 2020 to mid 2022, let's say a 5-6 quarter period, during that time frame, the prices that were paid for multifamily were completely imprudent. They're basically overpaid by perhaps 10, 20, 25%. And so what's happened is, as rates went up, you basically couldn't support those prices. You couldn't get those loans. And so what we've seen is about a 23 to 25% decline in prices from a peak of, let's call it February 2022. So if I look at the peak of the market, that was Feb last year. Yeah. And so now here we are, we're looking at September, October, this in 2023, and we're seeing about a 25% shift. And here's what's really interesting about this market. Got to say that people adore multifamily, because you would think that if the prices came down for something by 25% compared to single family, which might be down 2% or 1% or up 1%, depending upon which data point you use, so it's flat. Whereas with multifamily, prices have come down by 25%. You would think that there would be less demand. Well, there isn't. I'm selling a property, selling it very profitably. I bought it for 23 million. I'm selling it for 41 million. There were 12 offers. And 3 of those offers were money hard on day one, meaning sight unseen.
No due diligence.
No due diligence, money hard on day one. So the demand for multifamily is not down at all, but the prices are down about 23 to 25%. And that's what's happening in the multifamily market. And there's coming distress. I'm not even saying that this is the bottom of the multifamily market. I think prices have to go down by another 5%, possibly even another 10% in the worst case scenario, if the Fed doesn't cut at all next year, because there's distress coming. And you were implying that to that distress, you said people are basically overpaying. Well, here's the catch. If you overpaid at the end of 2020 or in 2021 or the beginning of 2022, well, your rate caps haven't expired yet. So isn't it all future distress? The distress really hits the industry in 2024 and then continues until maybe the first quarter of 2025. So we're looking, and it starts in the final quarter this year. So we're looking at 6 quarters of distress, upcoming distress, with the next quarter, the last quarter of 2023 being the first quarter, all of next year, and then the first quarter of 2025. 6 quarters of distress is what is multifamily is looking at. But that has nothing to do with the demand, which is still outrageous.
Okay, so wait a second. I just want to hold there for a second, because I got to ask you about that. So I was on Ken McElroy's show yesterday, and he likes to say survive till 25, right?
Yes,
and
I
you're
think he's
saying
right.
the same thing. But
I'm saying the exact same thing.
I know you are. How do you know that? Is that betting on a Fed rate cut by then? Or do you just know the length of the financing that these syndicate? It's mostly like a lot of these problems are caused by the syndicators who got out over their skis.
Yes.
But how do you know the timing that precisely?
Okay, so let's take 2 scenarios. One scenario in which the Fed cuts rates and the other one in which the Fed doesn't cut rates. In either scenario, the problem is solved by 2025. So in the rate cut scenario, it's solved one way. In the not rate cut scenario, it's solved a different way. So first, let's take the good scenario, and then I'll give you the bad one, right? Okay. In the good scenario, the Federal Reserve does what the market is saying right now on Bloomberg this morning. So we're in middle September, and Bloomberg saying, hey, the ratio of people that are now believing that the Fed will cut in Q2 next year is increasing. So the percentage of people that believe that there's going to be rate cuts in Q2 next year, in Q2 2024, is increasing. And it's been increasing for a while. I think that that's going to keep increasing. So let's assume in the good scenario, the Fed starts to cut rates in Q2 of next year. And then they cut a little bit more in Q3, a little bit more in 2024. I'm not assuming the kind of rate cuts, the aggressive rate cuts like the aggressive rate hikes we had. I mean a slow, gentle slope. So what happens then? Well, every time the Fed cuts the rates 1 quarter points, 2 things happen that stabilize the market in the good scenario. Number one, rate caps, which are humongously expensive right now, millions of dollars, they get cheap. Why do they get cheap? What is the reason why rate caps are cheaper? Well, the answer is very simple. Rate caps have nothing to do with interest rates. They have to do with the direction of interest rates. If the direction of interest rates is down, rate caps are cheap. If the direction of interest rates is up, rate caps are hideously expensive. So you don't actually need a very large amount of cuts. A single 1/4 point cut indicates a downward slope in the marketplace, and that is enough signal for rate caps to become cheap. Now, of the 2,500 properties that are in distress, remember, multifamily has 100,000 properties. So 2.5% of the market is in distress. And that 2,500, if the Fed cuts once or twice, all of a sudden rate caps get cheap. And the better part of those 2,500 properties, the properties that are still doing well, they're just suffering because rates are too high, they can renew their rate caps, and they can renew it without paying millions of dollars for it. Now, all of a sudden, a rate cap is 200,000, easy peasy, renew it, get another year. Now you're pushing the can out further, and your bank is helping you because your property is doing well. And let's say 1/3 of those 2,500 properties are the better properties, right? They just are suffering because the interest rates are too high. Now, what happens to the remaining 2/3? Well, even with the rate caps going down and the interest rate going down, some of those properties are still not going to be able to push the can down the future. So they have two choices at that point of time in this good scenario. Number one, they can sell the property. And now they can sell the property at a slightly higher price than they can sell right now in September 2023. Why? Because of the rate cuts. Every time the Fed cuts the rates, even by 25 basis points or 50 basis points, now your property is worth more money and you can sell it for more money. Also, there's a market called the bridge lending market. It's what got us into all this trouble because people got bridge loans and they went up. Well, the bridge market is dead right now. You know, the rates are too high. No one's using bridge. But what if in 2024, the rates are going in a downward direction? The bridge market is like rate caps. When the market rates are going in a downward direction, the bridge market roars back, and it roars back.
But explain to people why the bridge market exists. I mean, it's because these apartment complex buyers have purchased a property with the plans to remodel and re-tenant the property and raise the rents, right?
Exactly. And the reason why bridge isn't working right now is because with expectations of rate increases, there's still an expectation of a rate increase in November. It's very hard to make the numbers pencil for bridge loans. You can be basically, it's very hard to get them. But if we had one rate drop, two rate drops, the bridge loans become more available. And some of these properties, let's say another 1/4, can then refinance out of their existing bridge loans into a newer bridge loan. They're still in trouble, but they're now able to push the can down the road for another 1 to 2 years. And then there's going to be the final 1/3, which are in the Jesus can't save you category. And even in the best case, this is the best case scenario, right? This is the best case scenario. Well, those 1/3 of properties, let's call them 800 properties, they still have to be sold in the market, and they have to be sold at current prices. And at that price, every single investor in these 800 properties is going to lose every dollar. So how much money is that? Let's call it 8 or 9 million. So the average property investors have they're in for maybe 8 million, 9 million. So we're looking at a loss of potentially $4 or $5 billion in investor equity. Now, that seems like a lot. It's like $5 billion of investor equity will be lost when these 800 properties are sold. The answer is it's a tiny amount. It is a tiny amount. It will not, A, destabilize the multifamily market, B, destabilize commercial real estate, and C, destabilize the United States economy, because the US economy functions in trillions of dollars. In 2008, $8 trillion, that's $8,000 billion was at risk. And that's why the government had to intervene with $600 billion of, free money. Here, we're looking at investors losing, let's call it, $8 billion. Now, remember, this is the good scenario. So in this good scenario, let's call it $10 billion. Well, investors lose $10 billion. Boo-hoo, horrible for those investors. I'm not saying that this is anything but catastrophic for investors. I'm simply saying for the multifamily market, it is not catastrophic. And Ken McElroy is right. By the first quarter of 2025, properties have either been sold, been refinanced, or have gotten new rate caps. End of the process, survive to 2025. Now let's look at the bad scenario. In the bad scenario, the Fed keeps rates the same all through 2024. Even the Federal Reserve itself, their dot plot is showing, and they're really conservative. They're really conservative. They're way more conservative than the market. Like if you look at the market's, factoring in a lot more rate cuts than the Fed, but the Fed likes to be very, very careful with what they say. So let's assume that the Fed is wrong, and even its own dot plot is wrong, and the Fed does not drop rates at all next year. Okay, it just keeps them on a plateau, extreme worst case scenario, and the economy somehow keeps going even with these extremely high interest rates. In this bad scenario, pretty much all of those 2,500 distressed properties have to be sold in the market, and probably not at today's 25% discount. They'd need to be sold at a 30% discount or 35% discount.
Yeah.
In this scenario, you're looking at 2,500 properties. Investors are losing about 25 billion. So in the previous scenario, they were losing 8 billion. That was the good scenario. Here in this scenario, investors are losing about 25 billion.
Okay.
Once again, small number.
So you said it's about 100,000 properties around the U.S.
Multifamily.
What's the average price and unit count of those properties, if you know that?
It's the average. So there's 19.6 million apartment units in the United States, right? Total.
Yeah.
And of them, roughly 2/3, so let's call it 15 million, are the larger properties, which are in that 100,000. The rest are really small properties, right? So, 4-plexes and 10-plexes and 8-plexes. We don't really count them. We don't have data for them. So roughly there's 100,000 properties of 150 units, and they're worth today, let's call it between 30 and 40 million each.
Okay. So those are nicer properties, most of them. They're not workforce housing.
No, because most of the syndicators bought, they did buy, it is workforce housing. Let me explain.
Okay.
At the peak in 2021, the average price for a 150 unit workforce housing property had increased to $200,000 per unit.
Per unit.
Now you've got a 150 unit property multiplied by 200 grand. That's 30 million.
I just want everybody to comprehend what he just said for a moment. A workforce, in other words, low-end apartment building,
yes.
Like a
yes.
unit,
yes.
a low-end apartment unit that's
unrenovated.
What?
Yeah. Unrenovated.
Yeah. Unrenovated, maybe it's 1,000 square feet, give or take. It's, a 2-bedroom, 1 bath, not 2 bath, probably.
Yep.
Okay. It's in a kind of a crappy apartment complex, and it's maybe built in the 70s.
Yes, or 80s.
And
all of the properties that were purchased were pretty much 70s and 80s with a little bit of 90s.
All right. So think about that, folks. Just think about that and compare it to the single family homes you're buying. That's $200,000 for a crappy old apartment that's 1,000 square feet. Okay. And you're buying, like, you can literally go to jasonhartman.com right now and you can buy a brand new single family home in any one of some very good Alabama and Florida markets, starting at $260,000. When the average new home price in America is $475,000. Actually, that might be the median. I don't know. Don't quote me on that.
Well, I have a few bones to pick with that. I mean, in general, I'm in agreement with you, Jason, right? Obviously, those prices were completely lunatic, right? Yeah. So firstly, if you're looking at
what it really shows you, before you even address that, and pick your bone, feel free, but it shows you that there's a floor on the bottom of the market, right?
Yes.
Because there's nothing else you can live in. Right, except a mobile home. And so that's why I like entry-level housing, because there is a floor to that. And, I remember when I was a kid, I was maybe about to turn 16, and an adult that I knew was telling me about his first car and how cheap his first car was. It was a junker, right? And then I bought my first car, and, it wasn't much of a price difference, oddly, because the bottom of the market is the bottom of the market, and it just doesn't have much place to go down.
It's very inflexible. The bottom of the market is way more inflexible than the middle and the top of the market.
Of course, yeah.
And so these bottom end homes are really where there's maximum price value.
Yeah, and a lot of
safety, especially in a bad market.
Downside risk protection.
Exactly. A lot of downside risk protection. So having said that, let me make that more of an apples to apples comparison. Remember that 200K was at peak, right? Well, you couldn't really buy that 260K home that's on Jason's website at peak, right? So things have moderated or adjusted a little bit in the single family market as well, more in the multifamily. So now that unit is 150K. So it's not $200,000, it's 150K. Also, you can't really compare good markets like Alabama with the United States, because when I'm giving you that 150, there's Los Angeles units in there, there's San Francisco, there's Boston, there's Miami. Right. So that 150K is the average. If I was to say, what is the multifamily price today on a per unit basis in Alabama? it's 100,000 a unit.
Yeah, but I'll tell you, I remember looking at a deal, and I've owned a couple of big apartment complexes myself, 139 units, 125 units, Scottsdale, Oklahoma City. Those were those two that I owned. And those weren't syndications, those were direct ownership, right? So a syndicator was trying to talk me into investing in this deal in the Kansas City metro. And these units were 70s build, okay? They were I mean, I don't remember the price, but I just said the price per unit. Are you out of your mind? You want like 260 grand a unit for these things? I'm like, no way.
Well, I'm glad you didn't pay, because now they're
and I'm sure
probably
they've
170 a
moderated now,
unit.
but that guy made money on that project, he claims. So,
Well, he probably did if he still was in that window to sell before the interest rates went up, because, that's an irrational market. You can make money as long as the market stays irrational until the time of your exit.
Yeah,
right? But that doesn't mean you're very smart. It just means that your timing was good, right? And who can control timing anyway, right? So bottom line is, even if that person made money, the risk that you were going to take buying a Kansas City property at 260,000 a unit is massively in excess of buying an 80s, 90s built Kansas City single family home. Right? Especially because in Kansas City, you can get a very nice property at $200,000 in Overland Park. And Overland Park is a very sexy part of Kansas City. It's a very, very affluent park.
Been there many times. Yep.
So many different ways the multifamily market didn't make sense. But to come back to your question, and we took a while to come back to it.
Yeah. And we got to get on to
my friend Ken McElroy is
but
right,
go ahead. Yeah.
Right? Ken McElroy is right. Either way, the good scenario or the bad scenario, this basically gets resolved by the first quarter of 2025, because at that point, most of the distress has either ended because those properties are sold, or it has ended because those properties are refinanced, or they have a rate cap. 3 different scenarios. Either way it ends. In one scenario, investors lose $8 billion. I really feel for them. In another scenario, investors lose $25 billion and banks lose maybe another 15 or 20 billion. In the first scenario, in the good scenario, basically the investors are taking all the haircut, most of the haircut. In the bad scenario, the investors are still taking that same haircut, just more of them. And then the banks are taking a haircut as well, because rates are staying high, so the values are staying low. And so maybe 25 billion for the investors, 25 billion for the investors. And once again, I want to point out, in a $1 trillion market, $50 billion total between banks and investors is heartbreaking, but it's not a big number.
It's no big deal. Yeah. Right. Okay. Got it. Neil, so you mentioned banks, and I'd be remiss if we didn't talk about the banks for a moment. I did a show immediately when the Silicon Valley Bank collapse happened, and the other 2 banks also collapsed at the same time, right? And, there was this chart that was just all over social media, and every clickbait, fear porn, fear mongering YouTuber was publishing this chart. It was from Zero Hedge. Okay. And it showed all of these hold to maturity assets, most of them mortgage-backed securities, right?
Yeah.
That all the banks owned, and the percentage. And Silicon Valley Bank owned the most of them, and they were the worst off, right? But what it didn't show you, and nobody was talking about, I always try to ask myself, what isn't this saying? What isn't it telling me? What dog is not barking, right? That's what I want to know always.
Well,
right?
if it's Zero Hedge, there's definitely dogs that are not barking, because they every article is designed to make a specific point and nothing else.
Of course. So it showed you all of these percentages, but what it didn't tell you is what the rate of those hold to maturity assets was, when they purchased them, what their portfolio mix was of, they didn't buy them all at once. They're laddered, obviously, right? So, it's just such sensationalism, and it made people think that all these banks are going to start failing. There's going to be massive bank failures everywhere you look. The economy is over. And you know what drives me crazy is that, if you have a purveyor of blue sky, right, who's out selling you something that is hype and it doesn't work out, you can go sue that guy, right? But I think we should be able to sue all the people that discourage investment and make us miss opportunities, right? All of the clickbait, fear porn mongers that are causing people to miss opportunities are the ones that are causing people the most damage. So
they are.
Anyway,
they are.
What do
they
you
absolutely
think about the banks? Yeah.
Well, So I think zero hedge was right only in one way, and that is some banks will go out of business. I expect that to happen over the next 18, perhaps even 24 months. But there's nuances. You have to really study the financial system and understand it, right? In the United States, even a mid-sized bank, it has $250 billion of assets.
Right.
The total amount of money that is outstanding for loans for commercial real estate is about $1.4 trillion. But it's not all today. That's the total amount of outstanding money over the next 2 or 3 years. Now, once again, remember how I sliced and diced the distress in multifamily? You have to do the same thing for commercial real estate.
Of course.
Number one, the majority of commercial real estate was not purchased in the crazy time frame of late 2020, all of 21, and maybe the first half of 2022. Let's say Jason bought an office building and he bought it in 2017. And for whatever reason, he still has a bridge loan on it. So he's suffering right now, and the property is bleeding, right? Because he kept making money from 2017 to now, right? But he decided not to put fixed debt on it, right? And by the way, a significant portion of that market is fixed debt, but we're only addressing the $1.4 trillion that's floating debt, right? That's where the risk is. Well, what's the problem here? Jason, if he bought the property in 2017, even if he sells the property at a 40% discount to its value 2 years ago, he's still in the green because the value has been basically added over this time. He's in the black, right? He's in the black. He basically is making a lot less profit than he was going to make if he had sold it 18 months ago, right? It's possible that he might just basically break even. My point is, how would that create distress for a bank? It's creating distress for the investors who thought that they were going to make tens of millions of dollars and now are just going to get their money back. So a very substantial portion of that 1.4 trillion, what has happened is all the equity that this property had until 18 months ago is gone. It's vanished. The investors are not getting any profit out of it. Now let's move forward to the next tranche of properties, right? And in this tranche of properties, there's some equity remaining, but the investors are not going to get all of their money back. Maybe there was this $50 million office building and there are $10 million in investors. They get a haircut, $2 million, lost, $3 million lost, $5 million lost, $8 million lost. Now, in any of these scenarios where there's huge distress for these investors, they're losing money. But is there any distress for the bank? No, because all $10 million of equity has to be lost for the bank to even have any amount of distress.
The bank did a conservative enough loan with a good loan to value ratio that they didn't, it's not what they were doing in 2007, 2008, right?
Exactly, right? And then there's the worst kind of properties out of that 1.4 trillion. And I would say probably a third of those properties, maybe $400 billion worth, are in the bucket of the banks will lose money. But here's the part that Zero Hedge doesn't say. Zero Hedge writes articles as if the banks are going to lose all of their mony, which essentially means that these properties are worth nothing.
Yeah,
nothing, like no dollars. They're worth $0.
Yeah, it's right. This just gets my goat, Neil. I agree with you.
Yeah. So in my scenario, I had a $50 million property, and it had, let's call it $15 million worth of investors. All of that 15 million first is wiped out, so the value can go down by 30% without the bank getting hurt. Now, let's assume the value goes down by 40%. Right? Yeah. It hasn't happened for any asset class yet, but it could happen. Right?
Yeah.
Well, in that scenario, the bank out of their $35 million loan has lost $5 million, right? Which is
not
15% of their loans.
Yeah.
So out of that $400 billion, which is truly, truly, truly at risk for banks, if they lose 15% of that, that's a $60 billion loss. But the $1.4 trillion number is the one that I'm afraid of and everybody else is afraid of. And that's the number being thrown out there. But the actual loss that the banks go through, that's 60 billion. And that's assuming that the banks do not work out a single arrangement with any buyer, because some of the buyers are rich, right? So they go to the banks and say, okay, you know what? My property is not worth anything. I want to hold it for the next 4 years.
Hey.
I'm going to give you next 4 years of bleed. I'm going to go and put it in your bank.
Yep.
So you already know that the next 4 years you will get your mortgage.
Yep.
Just push the can down the road. Why would a bank not do that?
Yeah, of course the bank's going to do that. And the other thing is some of these loans are recourse loans. They're personally guaranteed by wealthy people. So the bank is not going to take a hit. Now, the investor might. But Neil, one of the things that we've got to talk about, and I meant to ask you this on the multifamily, is Who are the investors? Because, when you talk, like most people are thinking, oh, some doctors got together and bought a property together or something like that, which certainly is part of it. But, I want to just give you a little bait for this discussion because, as we all know, you can do some interesting things with life insurance, right? Yep. I don't think it's like the holy grail, but it's interesting, right? And I do it too. There are some interesting structures you can use and things like that with life insurance. But what people fail to think about is that, life insurance is not a guarantee. These companies can go under too. And let me tell you, don't give me the thing about, they've been in business 150 years. Well, so was Lehman Brothers, okay? And AIG would have failed if we didn't
give them $85 billion of our money.
So you should diversify just like any other investment, okay? You shouldn't just have all your eggs with one company. But a lot of these properties, especially the office space properties, life insurance companies have been the investors in those and pension funds. So, a lot of these pensions that people are like banking on, they're not going to not get anything, just like the bank isn't going to go under, right? But they may take a haircut for sure, right? So tell us your thoughts there.
So firstly, you have to understand that institutional investors bought a lot of properties during the last 3 or 4 years, especially in office. Office is a very highly institutional class. And these people, these investors, they lose money all the time, right? SoftBank is the largest .com investor in the world. They lost $40 billion on their WeWork investment. $40 billion
was such a scam.
Right? And here's the thing. SoftBank is still working. SoftBank is still, going. And guess what? They had 1 year of losses, and this year, again, they're profitable. So my point is that when you're a pension fund that is managing $50 or $100 billion, and out of that $100 billion, $10 billion is invested into real estate assets. And let's say that the situation was so dire that you lost half of that money. It's really difficult to do that, by the way. The whole market has to crash for you to lose half of that money. But let's assume that you lost half of that money. So you've got basically, firstly, a small portion of your total assets is in real estate, and you've only lost half of that. It's possible that many of those companies are still issuing dividends, even as they're losing these multifamily buildings, because they've got other assets. They've got other classes. They're invested in single family. They're invested in non-real estate assets. They're invested in Bitcoin. They're invested in the stock market. Understand that structurally, the way markets work, there's a lot of resiliency because these investors were listening to Jason Hartman when he said, diversify. They're in 10 different asset classes. One of them is office or multifamily. And that's why this concept that, $1.4 trillion of loans will come due and they won't be refinanced. Now ask the question, what is the likely bad scenario for banks? And I think you'll come up with a number of $60 to $100 billion. And while that seems like a lot of banks will go under, a typical mid-sized bank has $250 billion in holdings. And the total distress that I just described across all the mid-sized banks in the US is $60 to $100 billion.
And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.